What is going on, investors? Hopefully, guys are doing well out there. Time to move earnings season right along. We're technically kind of towards the tail end of it, or really kind of the beginning of it, depending on which way you look. We should have a little bit of a gap here where we don't have a lot of earnings. We'll have Nike next week, but then we'll roll into what's considered a new earnings season towards the second week of October when we look at the financial stocks. We'll have a lot of videos kind of previewing some of this stuff, but we've got a very important one today. We're going to look at FedEx Corporation, ticker symbol FDX. Some really interesting stuff coming out of FedEx over the last week or so. So this company last week on September 16th actually pre-announced their earnings, and this earnings season and really this year in general, when a company's pre-announced, it's really, really bad. We saw it with Snapchat earlier this year. Handful of other companies we've seen also quote unquote pre-announce, which basically means they give you kind of preliminary numbers to their earnings, and that's typically a recipe for disaster. And that is exactly what we saw with FedEx. I mean, this stock fell off a cliff when it pre-announced its earnings, and they were terrible. Okay, really though, just on the earnings side. Okay, so the revenue that they pre-announced was $23.2 billion. When they announced their earnings, guess what? It came in their revenue, it came in right at $23.2 billion. But where they really disappointed Wall Street was the fact that they expected their EPS for the upcoming quarter to come in at $3.44 per share. I'm seeing here, at least on a diluted basis, they were at $3.33 per share in the most recent quarter. Now, what you might be wondering is, what was Wall Street expecting? They were expecting $5.14. That is not just a swing and a miss, but that's strike one, strike two, strike three type of miss. And so the stock just really collapsed on that day. You can actually see it here in this small graph here. The stock was up over $205 per share and then slammed all the way down to like $160 per share. And quite frankly, it's been sliding ever since there. They also gave us guidance for the upcoming Q2 as well, which was very similar to the quarter that we just pre-announced essentially. So Q1 we'll talk about in depth on today's show. We'll come over here, we'll look at the revenues, we'll look at the profits, the cash flows, all the different business segments with FedEx. We'll also look at this obviously from a technical perspective. When a stock like this goes down this much, you can imagine historically it's done that several times, and every single time it has actually been a buying opportunity. So we'll see if anybody has had the balls to step in on FedEx, because whenever a stock drops this much, the news is so bad. And look at the upcoming Q2 guidance that we got. So they're expecting EPS to come in right about $2.75. The consensus estimate was for $5.46. It's nearly 50% lower on that earnings side. Just an absolute complete disaster. Just shows you the difficult times that we're in. Now, every single time stocks like this dip, it's different every time. Obviously, this gigantic dip that we saw back in March of 2009, a great financial crisis. In the early 1990s, obviously, some rough economic times. And then more recently in 2020, obviously, COVID-19 just absolutely obliterated this stock and the stock market in general. But every single time, this stock and many others that run a quality business snap back. But from the revenue side over at FedEx, things are actually holding up a little bit. So to me, this is a pretty easily explained pullback when it comes to the earnings. When you have fuel cost, we'll show them to you. Fuel cost year over year up just 81%. I say that jokingly, up 81% from $1 billion all the way up to $1.8 billion. When you look at the trends for oil, especially over the last 90 days or so, this is something that we're expecting to likely continue to pull back over the next, we'll call it 12 to 24 months. So revenue, I'll try not to mix those up. Sometimes it's been a long day, but look, revenue actually holding up over at FedEx. So what's that showing me is there actually is still underlying demand in the economy. And that may not be a good thing from a macro perspective, because what the Federal Reserve is trying to do is tamp down inflation. In other words, tamp down demand. We're actually seeing demand for FedEx business still be there. Consensus estimate for Q2 in terms of what Wall Street was expecting on the revenue side was $24.8 billion. The company came in just underneath that in terms of their guidance, expected $23.5 to $24 billion. So this is one of those weird situations where there's still demand on the revenue side, but the earnings are getting obliterated by the financial condition, the inflationary condition that we're seeing right now. Now, what we are seeing right now is those Q1 numbers. We'll dig into these Q1 numbers. Revenue came in again at the pre-announced number at $23.2 billion. That was 5.5% growth. That missed expectations by a lot. I just showed you expectations were roughly about $580 million higher. Again, on the revenue side, that is not where the gigantic miss is, and that's not what is sending this stock lower. It is really on that earnings side where you're seeing quite a bit of gap between what Wall Street was expecting and where FedEx is delivering, so to speak. Now, speaking of those revenue estimates and expectations for FedEx in the coming quarters, this is basically a no growth, okay? Especially in an inflationary environment where you have inflation at the very least. We're projecting out maybe 12 months. It's not necessarily going to grow 8% year over year on a quarterly basis, but probably 3, 4, 5%. Well, this company is not really keeping up with that when it comes to the inflation numbers in terms of their revenues, expecting between $24 and $25 billion worth of revenue, essentially out into infinity, or more specifically out into 2025. From the earnings side, we are going to go negative for the next couple of quarters. And that is the rub in the entire stock market, but certainly as it pertains to FedEx, is a lot of analysts are starting to pull back expectations. In some cases on the revenue side, we're seeing this with some companies, but particularly on the earnings side, especially when it pertains to FedEx, is we're going to go negative in Q2 in terms of earnings growth, just $2.80 per share estimated. Again, Wall Street was expecting much, much higher than that. You were going to go negative in the third quarter. You're going to go negative in the fourth quarter, but somehow magically everybody is expecting, including Wall Street, at least they haven't gotten this far out. And it's hard to have visibility out into basically Q1 of 2024, or really the third quarter as we think of it as a calendar year of 2023 for FedEx. They're on a funky kind of fiscal calendar year because obviously they just reported Q1 results in a quarter most of us think is either late Q2 or early Q3. Somehow magically, a year from now, we're going to reaccelerate those earnings back to 29, 59, 32%, really out for the next couple of years. Now, some of that has to do with the fact that the earnings in the most recent quarter are just a disaster, but some economists, some analysts out there probably expecting some kind of softening of energy prices. That certainly would benefit this company, although that's not really one of the major costs at FedEx. It's really the salaries and purchase transportation and rentals. Those things are actually, in some cases, equal to or slightly ahead of where the fuel costs are. So certainly if fuel costs can wane, it will help FedEx, but it's really those salaries and running the business slightly more efficiently, which will benefit this company. The company talked at length on its kind of pre-announced, but also on its conference call today. They talked at length about how they're going to be cutting cost and becoming a little bit more efficient business. They've got a new CEO there. Obviously, that person wants to put their stamp on this business. Obviously, if he's able to turn these types of things around, he's going to be very well compensated, and likely the stock is going to head much higher. Now, we talked about from a technical perspective, there's been times when FedEx has had massive drops, and we obviously saw it back in the great financial crisis. In fact, we had an over 70% drop on this stock. We've seen it more recently during the start of the health situation that we had back in 2020. I mean, we're still dealing with it now, but it basically came on shore. You had a 66% drop on this one. And then obviously more recently, we've kind of gone from the highs back in maybe January or late last year. You're down 53%. I tell you what, every time this stock has gone down 50, 60, 70%, it's actually snapped back relatively quickly. That is why when you see stocks make these moves, the knee-jerk reaction is to understand that yes, things are probably going to get worse, but more than likely than that, things are going to get better very rapidly. And if you're sitting on your hands or you've got your money parked in a 2-year, 4% yielding kind of instrument, well, all of a sudden, you're going to miss a move. Again, to the downside, these went down 50%, 60%, 70%. Literally, this is a weekly chart with FedEx to give us this broad view. You're looking at just over the course of a year or so, these stocks can be obliterated. But then on the other side side of this, you can bottom back in March of 2009, like a lot of stocks, and then literally less than 6 or 7 months later, have a 63% rise in FedEx. Same thing happened back in March. I don't need to explain this to you since most of you are very much aware that literally in like 6 or 7 months, almost the exact same timetable that we saw during the great financial crisis, this thing snapped back to over a 69% gain. That is why over the next couple of months, I am not going to sit here on the channel and say stocks have bottomed at this moment, or they're going to bottom at this number, or bottom when the S&P 500 does this, or when the Fed does this. The thing you have to realize is if you're sitting on your hands and you're scared, you're going to miss out on some of the greatest gains that you will ever see in your lifetime, certainly your investing career. And the main thing to understand is, yes, you have to suffer through some pretty big drawdowns with all stocks, but certainly as it pertains to FedEx, you're going to suffer 70%, 60%, 50% drawdowns. But typically, very typically, these things bounce back very, very quickly. You need to be ready for this. And then when we look at this from a traditional valuation perspective, you can imagine that right now you are sitting on a historic level to buy FedEx from a price to earnings basis. Excuse me, this is a price to sales basis because I pulled up price to earnings, and obviously with their earnings really fluctuating, it creates kind of a weird chart that doesn't really mean a whole lot. But from a price to sales perspective over at FedEx, because again, the sales are still there. The company is still guiding for relatively inline expectations when it comes to their revenue estimate. There still is demand there. It's really that supply side on that labor and certainly on that fuel charge as well that is really driving up inflation. So when we look at this company from a price to sales basis, it is trading at just 0.44 times sales. Now, over the last, I have a max chart here. So we've got more than 20 years of data. The times it's gone south of 0.5 times sales, you guessed it, during the great financial crisis, during the March lows that we can obviously easily explain away, and then obviously right now. Now, can this stock continue to go lower from a price to sales multiple? Can it certainly go lower from a price perspective? Yes, absolutely, but take it from somebody that has been invested in these markets not quite as early as back in here in the early 90s, but from 1997 to today, I have seen plenty of drops and pops in the stock market, and every single time people think that it's going to be different than the previous drop, that it's somehow just going to continue to go down and down and down and down and turn into like a 90, 100% drop in these types of things. I am not seeing that with FedEx. I would be far more concerned about FedEx is if their revenue estimates were so out of whack. If that was 50% lower than what Wall Street was expecting, then I'd be like, guys, holy crap, we've got to buckle up because the next probably 12 to 24 months is going to be really ugly. No, this company still has demand for its products and its services. It's really just that inflation and really the inefficiencies inside of its business, which need to be cleaned up. Times like these is when you clean it up, and then all of a sudden you come out on the other end where economic times start becoming really good. And now you've got a clean, efficient business that's wildly profitable. Well, that's the recipe for a fantastic investment. Now, let's dive into these Q1 numbers. We had $23.2 billion. Again, that was pre-announced and then confirmed today. What we've pointed out over at FedEx over the last couple of quarters that we've done videos on this, and actually I haven't seen a lot of commentary on this, is this freight segment at FedEx. This is where you want the growth to be at FedEx. We notice that this is the fastest growing business. Yes, you have this services segment that's up 100%, but $70 million is a rounding error when you have $23.24 billion worth of revenue. It's really this freight segment. And the reason why I'm showing you this and making emphasis of this is obviously the express segment leads in revenue. In fact, it has for as long as I've been analyzing FedEx, $11.1 billion worth of revenue. That was up just 1% year over year. You've got the ground segment. Okay. These are a lot of the packages that arrive at your door over the course of several days from being shipped. So you have the ground segment up to $8.1 billion. Last year, it was at $7.7 billion. That was a 6% rise on that one. Now notice though, your freight segment, okay, it's not $11 billion, it's not $8 billion, but you got $2.7 billion worth of revenue. That was up 21%. So a fast grower. But here's the key that we've been pointing out here on the channel, every FedEx video that we've done. Come down here to operating income. Here's your express segment. Year over year, you're down 69% on your operating income, from $567 million worth of operating income down to just 174. I mean, this is as low as margin business as you'll find that actually spins out a profit. So off $11 billion in revenue, you spit out just $174 million worth of profit. That's really, really bad. The ground segment is not much better. Off of $8.1 billion worth of revenue, you had just $694 million worth of operating profits. That's just 3% growth year over year. What has me so excited about FedEx, and if they can maintain this type of growth rate in the FedEx freight segment, is off of $2.7 billion worth of revenue. Look at your operating profits right there at $651 million. We actually theorized on previous videos that the freight segment actually could become the most profitable business unit at FedEx, despite far lower revenue numbers. And here we are, we're very close. It's not quite as up to where ground is, but look at the year over year growth. You're up 67% from 390 to 651. And I'm going to humbly sit here and tell you, I have absolutely no idea if this freight segment could not only continue this type of growth on the revenue side. I think that's the most important part, but can they continue this type of operating income growth as well? And if the answer to both of those questions is yes, or even kind of maybe probably yes, well, this stock can be a buy just based on that type of result. Because when your fastest segment in terms of revenue growth and your fastest segment in terms of operating profit, if that can sustain itself, maybe not into infinity, but over the next 12 to 24 months, or maybe even 36 months, well, that can be very, very bullish for FedEx in the longer run. Company, like we said, in the most recent quarter, earned $3.33. When a company starts to rein in their earnings estimates, and certainly Wall Street as well, I like to come over to the dividend rate. You're getting $4.60 per share. Again, that's on a full year. I think this quarter was pretty bad. It's probably going to get a little bit worse over at FedEx from an earnings perspective, but they have plenty of money to cover that dividend. From the balance sheet perspective, they've got plenty of cash based on the cash flows and the earnings, even though the earnings obviously have been reined in, still plenty good enough. They have plenty in receivables as well. They do have some long-term debt, but it's not, look, it's not like Carnival Cruise Lines or some of these other companies that we might look at where it's just this astronomical amount. You got about $19 billion worth of long-term debt, and they have a current portion of just $139 million, which they should be able to pay off and not necessarily roll over into a higher interest rate. Now, when you come down to cash flows, they really consolidated here, but off of net income in the most recent quarter of just $875 million. Last year, you were at an excess of $1.1 billion worth of net income. You come down here and look at the cash provided by those operating activities. That, as you'd expect, got shed in quite a bit, okay? Down almost 50% from $2 billion down to about $1.6 billion. I guess that's closer to a 40 or 45% drop on those cash flows, but they have plenty of cash to cover it. Now, some interesting thing that they also pointed out in their guidance was the fact that capital spending for the fiscal year, that's the upcoming quarter, essentially the quarter they just announced was Q1. So obviously we've got 3 more quarters to go, but we're expecting about $6.3 billion worth of capital expenditures. So those are actually going to accelerate, because if you divide $6.3 billion divided by 4 quarters, you get to about a shade over $1.5 billion. That was on the run rate where they were a year ago on a quarterly basis. They did $1.57 billion worth of capital expenditures last year. This year shed down to $1.28 billion. So if they do want to hit this $6.3 billion worth of capital spending, it's actually going to accelerate over the next couple of quarters. In fact, it's probably going to be closer to $2 billion. So that's what has some investors worried about this stock, is the fact that last year you earned $2 billion worth of cash provided by operating activities, and things were a lot better this time last year when this company reported. Now you operated just on $1.6 billion worth of operating cash flow, so you were probably going to go to cash flow negative over at this company for the next 3 quarters. Certainly when you look at the revenue guidance, not really growing that much on the revenue side, and then you come over here and look at the analyst estimates for the earnings side, you can probably assume that the cash flows are probably going to get negative, probably not going to get much better than $1.6 billion. And the company is going to likely do nearly $2 billion worth of capital expenditures for the next 3 quarters. Because again, they announced that they're going to do $6.3 billion worth of capital expenditures. They just did a quarter where they did 1.3. So it's actually a little bit less than $2 billion. So I'm kind of overestimating there. But I think this company, they might not be negative cash flow when you turn from operating cash flows minus the investing activities. It might be close. My guess is they're probably going to shoot for kind of a break even in terms of that. Now you do have dividends, you do have buybacks as well. The company committed, I believe, to about $1.5 billion worth of common stock buybacks during the next 3 months. They said that they're going to buy back $1 billion of that. So they're going to do $1.5 billion over the next 3 quarters, but they basically committed to doing $1 billion just in the quarter that we're in, basically the second quarter for FedEx. So they're going to really accelerate that $1.5 billion buyback. So that should give you a little bit of support when you come over here and look at the stock from a technical perspective. Again, I'll remove some of these big drops. Again, this is why it's so important and why I'm going to be stressing this. Some of you guys are going to get annoyed by this, but over the next, really probably the next 6 months, I'm going to stress to you, have a plan with every stock that you're looking to buy, because as these stocks pull back, and believe me, I have experience with this, not just, 2020 was a blink of the eye. Okay. 2008 and 2009, I remember that time so vividly, constantly buying stocks and then month over month, them constantly continuing to go down. I continued to pile into them. And I've told this story numerous times. 6 or 7 years later, I sold every single stock that I bought in 2008 and 2009. And look, I could have held on to them and probably been up a little bit higher, but I actually put it into real estate. And the value of the house that I'm sitting in right now has probably more than doubled. Now, I've put a lot of money in and I've done a lot of improvements with this house. So some of that has to do with the fact that this house has doubled in value. But it was a great trade-off. I invested when everybody else was trying to sell and run and hide for the hills. And then several years later, put it into real estate, which obviously has outperformed the stock market, quite frankly, over that time as well. I think we're in for a similar type of thing over the next, I would say it's probably 6 to 12 months that you have where stocks are just going to make these big move downs, and these are your opportunities to buy. Now, FedEx has pulled back, but I showed you here, I do have a weekly chart over at FedEx here, and what I've identified is 2 gigantic channel lines. Okay, we've got the bottom of the channel that we touched back in the early 90s. We obviously touched it during the great financial crisis, and then we touched it during the early days of those March virus lows. Now, it looks like to me, we're not much higher than this. Okay, if this stock makes a quick move down and tries to touch this line, it should touch it in the 120 to 130 range. That is just about $30, $30 to $40 lower than where the stock is today. So if you like FedEx, you need to be prepared to step in and buy this stock. Now, if you want 100 shares of this stock, would I immediately buy all 100 on one day? Absolutely not. During the financial crisis, I was dripping money in slowly by slowly. I had just closed a business. I had excess inventory. I was literally selling that inventory on eBay. And as I got paid from eBay, I was slowly dripping my money into the stock market. Believe it or not, I wasn't paying my rent. Sorry, landlord that I was renting from at the time. At one point, I actually got kicked out. After that, I started sleeping on couches because I was trying to pour every single dollar into the stock market because I knew what was going to come on the other side. And I know what is going to come on the other side for stocks like FedEx and a lot of stocks that we cover here on the channel. We're likely in for some more pain over the next 6 months, but that pain is your greatest opportunity, and you need to take that opportunity this time because it's only going to happen 3 or 4 times in your entire life, especially if you're not 20 years old. If you're 20, you might get 5 or 6 cracks at this, but if you're my age, 40 years old and over, you might only get one more time to buy stocks at these valuations, and you need to take it when it presents itself. And we are right there with FedEx. I wouldn't blame anyone for stepping in and buying a small position about where this stock is, considering the fact that this company's revenue estimates are still holding up. They're probably going to be pulled back just a little bit, but the company is still guiding for plenty of revenue. They're going to come out on the other side of this and be wildly profitable when they trim excess staff, when they trim excess capacity that they don't necessarily need, when they run a leaner business. This company is going to be wildly profitable. It doesn't have a large PE at the current time. You get a dividend. And on top of that, just over the next 2.5 months, this stock is going to buy, or this company is going to buy back $1 billion worth of stock on a $40 billion company. That is going to eventually put some kind of demand underneath these shares. And the people that take the risk, okay, the people that go park their money in a 4% 2-year instrument or some money market fund and say, oh, I feel so safe, I'm making 4%, which doesn't even beat inflation, but boy, I feel great. Those people are going to have the same amount of money they do today 2 years from now. The people that take the risk and buy stocks, quality stocks. We're not talking about Plug Power and Neo and some of these crazy speculative stocks. We're talking about quality companies that have quality businesses and cash flow and buybacks and dividends. The people that step in and buy these stocks during these times are going to be 2 years, 3 years, 4 years, much wealthier than they are today. I was sleeping on couches when the great financial crisis happened in 2008 and 2009. And while you might catch me sleeping on a couch these days, I might have a $60,000 watch on. I'm definitely not worried about my financial condition because I've made some wonderful decisions and I've taken the risk when the reward was very much in front of you. The reward is in front of you. It is going to take a lot of guts and a lot of courage to step in when everybody else is running and hiding. When everybody else is running and hiding, folks, that is when you take your shot in these markets. Hopefully you guys enjoyed today's video. A lot of videos that we're going to be doing over the next 3 to 4 months is going to be encouraging you to take these risks. And I promise you, if you take them, you're going to look back in 2, 3, 4, 5 years and thank goodness that you didn't put it into some 2-year instrument and that you actually took the risk that a real investor would take at this time. Hopefully you guys enjoyed today's video. Be back again tomorrow for the FANG Stock Recap Show. Good luck with your investments.